Let's get started. Before we delve into the strategy itself, let's take a moment to understand who Larry Williams was and what he achieved in the world of trading. Larry Williams, born in 1942, was not your average trader. He was a true pioneer, an author, and a successful trader who made significant contributions to the field of technical analysis and trading strategies. Larry Williams wasn't just a trader, he was a champion trader. In fact, he is known for winning the World Cup Championship of Futures Trading, earning him reputation in the trading field. The World Cup Championship of Futures Trading is a prestigious and highly competitive trading competition that gathers some of the best traders from around the globe to compete against each other. Larry's most astonishing victory in this championship was in 1987. In that year, he managed to turn a $10,000 trading account into a staggering $1.1 million in a single year, resulting in an impressive 11,000% net profit. Just to put it into perspective, achieving 11,000% net profit is equal to investing in Bitcoin in 2015 or the S&P 500 way back in 1958. But what makes this victory even more astounding is the fact that the runner-up who secured the second place earned only $150,000 during the same period. This massive difference in profits showcased Larry's exceptional ability to read and predict the market effectively. But Larry's contributions extend beyond his personal trading success. He was also an author who shared his insights and strategies with the trading community. His books such as Long-Term Secrets to Short-Term Trading, Day Trading Futures Online, and The Right Stock at the Right Time have become well known for traders worldwide. He also created numerous indicators, including the Williams Percentage R and the Ultimate Oscillator, that have become useful tools in the toolkit of traders. His reputation as a trading legend and educator makes any strategy associated with his name instantly interesting. So, with a nod of respect to the legend himself, let's dive into the strategy that's been causing a buzz and see how it really performs in the unforgiving world of backtesting. I have to mention that I'm sure that this is not the original strategy, as when I did my research I found that the mentioned strategy uses different stop loss placements along with a time-based force exit. For those who are seriously interested, I will provide a link to the original strategy in the video description. Okay, I will be showing you 3 different versions of this strategy. Each one is a bit more complex than the previous. Let's start off with the basic strategy. First of all, open up TradingView and set up the EUR/USD 5-minute chart. Once you got that, open up the Indicators tab and let's set our indicators. We are going to use 3 indicators, so first type in Donchian channel and add this one to your chart. After that, type in Large Trade Index and add the Larry Williams Large Trade Index by locks. Finally, type in Volume and click on the Simple Volume indicator. Okay, we have all of our indicators needed, but we are not done yet. We need to change some settings. So first, open up the Donchian channel settings and set its length to 96. Then switch to the Styles tab and change the basis line style to step line. This way we will be able to see where to put our stop losses. Okay, next up, open up the Large Trade Index. Change its period to 25. Finally, open up the volume settings. Change the MA length to 30. Then switch to the Styles tab and tick the Volume MA option and change its line style to step line. Now let's go over the rules for longs and shorts. Here is a valid long entry signal. For a valid long entry, we need to see that the price pushes the Donchian channel's upper band up. This is our Donchian channel's upper band, and as you can see on this candle, it pushed it up. Next up, we need to see that the Large Trade Index is green. And as you can see on that candle, it was indeed green. Finally, we need to see that the volume is above the volume-based moving average, and if we zoom on the volume indicator, you can see that on this candle the volume was above the volume-based moving average, which is this white line. Now the stop loss and take profit placements. The stop loss is going to place at the Donchian channel's middle line or at the lowest point of the last 10 candles, whichever is closer to the entry level. So in the original video I saw a subjective point which was to put the stop loss at the last swing low. But as I always emphasize, to only test objective rules-based strategies, I made this rule into an objective one, which is to put the stop loss at the lowest point of the last 10 candles or at the middle line. In this case, you can see that all of the conditions are met for a very long entry, so we can enter at the close of the signal candle or at the open of the next candle. For the stop loss, we either use the middle line or the lowest point of the last 10 candle, whichever is closer to the entry level. In this case, if we count back 10 candles, 1, 2, 3, 4, 5, 6, 7, 8, 9, and 10, as you can see, this was the lowest point. This point is closer than the DC middle band, so we are going to place the stop loss at this level. The take profit will be at a 1:2 risk-to-reward ratio. And as you can see, this trade was a winner. Now let's see the rules for shorts. Then we will move on to the second version of this strategy. Here you can see a valid short entry signal. For a valid short entry, first we need to see that the price pushes the Donchian channel lower band down. As you can see, this is the lower band, and on this candle it pushed it down. Next up, we need to see that the large trade index is red. If we take a closer look, we can see that it is indeed red. Finally, we need the volume to be above the volume-based moving average. And the volume is above the volume-based moving average, which is this white line. So, all of the conditions are met for a valid short entry. We can enter into a short position at the close of the signal candle or at the open of the next candle. The stop loss will be placed at the Donchian channel middle line or at the highest point of the last 10 candles. Again, in the original video, this was a subjective stop loss placement, but as I only test objective rules-based strategies, I will use the last 10 candles to define the swing high. Whichever is closer to the entry level will be our stop loss. So in this case, the Donchian channel middle line is right here. But let's find where is our swing high. Count back 10 candles. 1, 2, 3, 4, 5, 6, 7, 8, 9, and 10. And as you can see, this is the highest point of the last 10 candles, and it is closer to the entry level than the Donchian middle line. So we placed our stop loss right at that level. Take profit will be a 1:2 risk-to-reward ratio. And as you can see, this trade was another winning one. Okay, now you know how the basic version of this strategy works. Let's move on to the second version, where we'll be using a resistance filter. For the resistance filter version of this strategy, we will use one more indicator, which is the breaks and retest. So open up your indicators tab and type in resistance with breaks. Add this one to your chart. Now open up its settings and change the lookback range to 50, untick the retest option, and change the repainting to off candle confirmation. With that, we have this indicator set up. Now let's see the rules of this version. Here you can see a valid long entry signal. For a valid long entry, the first 3 rules are exactly the same as before, but after that we have an extra rule which makes this version different. The 4th rule is that the target does not cross a resistance level. So for example, if all the first 3 conditions would met on this candle, we couldn't have entered into this position as here is a resistance level, and even a 1:1 risk-to-reward ratio position would cross this resistance level. But with this long entry example, as you can see, all of the conditions are met. So we can enter into long. Stop loss and take profit placements are just the same as before. So let's move on and see how a short example looks like. Okay, here we have a valid short entry signal. Again, the first 3 rules are met. So the price pushes down the Donchian channel's lower band, the volume is above the volume-based moving average, and the large trade index is red. Finally, as you can see, here we have a resistance level. And as the 4th rule says, the target does not cross a support level. So we can enter into a short position. Stop loss is again at the recent swing high or at the Donchian channel's middle band, whichever is closer to the entry level. The take profit is at a 1:2 risk-to-reward ratio. and as you can see, this trade was a winner. Now you know how the second version of this strategy works. Finally, let's see the third version of this strategy. Okay, for the third version of this Larry Williams strategy, we won't need to add a new indicator. The first three rules are the same as before, but the fourth rule is again changed. In this version, in the past 10 candles, we need at least 2 candle closes above the resistance. This means we can only enter into a position at a resistance break. So, as you can see, here is a valid long entry signal. First of all, the Donchian channel's upper band is pushed up, the volume is above the volume-based moving average, and the large trade index is green. Finally, here you can see a resistance level, and here is the break of that resistance level. So this is the first close above the resistance level. Unfortunately, the second candle closed back below the resistance level, but then we got another close above the resistance level. So this was the first close above, and this is the second close above the resistance level. This means if all of the other conditions are met, we can enter into a long position. Stop loss will be just like before, either at the middle line of the Donchian channel or at the lowest point of the last 10 candles. As you can see, here the Donchian channel line is closer to the entry level, so the stop loss is placed right there. Take profit is again a 1:2 risk-reward ratio, and as you can see, this was another winning trade. Finally, let's see the rules for shorts, then I will go over all the 3 backtests. Here we have a valid short entry signal. First of all, the price pushed the lower Donchian channel band down, the volume is above the volume-based moving average, and the large trade index is red. So the first 3 conditions are met. What about the fourth one? The fourth condition says that we need at least 2 candle closes below the recent resistance level for a valid long entry. Well, as you can see, here is the resistance level. The first close below that resistance level was right here. But as the Donchian band wasn't pushed down, it can be a valid short entry signal. After that, we have another close, but again, no push down on the lower band. The first push down on the lower band was right here, but as the volume is green, we can't enter into a short. The next push down happens right here, and as you can see, we had at least 2 candle closes below the resistance level, and all of the other conditions are met. So we can enter into a short position at the close of the signal candle or at the open of the next candle. Stop loss will be placed at the middle line or at the highest point of the last 10 candles, whichever is closer to the entry level. In this case, here was the highest point of the last 10 candles, and it is closer than the middle band, so the stop loss will be placed right here. The take profit level is again a 1:2 risk-reward ratio, and as you can see, it got hit right there. So this was again another winning trade. Of course, these were cherry-picked examples. So now let me show you the real test, which is a 100 trade backtest. If you want to get access to our highly optimized and customizable premium trading view scripts that are designed for trading automation and are already proven to be profitable on live market data, check out our Patreon page and become a Smart Trader tier member. By becoming our Patreon supporter, you will also get access to the TradeSmart Discord, where you can exchange ideas with other like-minded traders who have already profited using our automated scripts, and you can also connect with us, the TradeSmart team. Get started now by clicking the link in our description or the pop-up in the top right corner. And the results are in. I will show you 3 different backtest results as I tested 3 different versions of this strategy. All of the 3 backtests were conducted on the same time interval. The first backtest is for the very basic Larry Williams strategy. After 100 trades with a 1:2 risk-reward ratio, the strategy had 30 winners and 70 losers, which brings the strategy to a negative 10% net profit with a 0.857 profit factor. Time to complete the 100 trades was 48 days. Taking a quick look at the equity curve, at the beginning, the strategy had a nice run-up, but after the 14th trade, it took a deep dive and ended in a sideways curve. Well, there's not much to say about it. In this form, this strategy is useless. But maybe in the next backtest with the resistance filter, it will get better. Let's see. In the second backtest, in which we used the resistance filter, meaning that the entries were not allowed if the target would cross a resistance or support level, on the same time interval, the strategy took 82 trades, had 23 winners and 59 losses. These results brings the strategy to a negative 13% net profit with a 0.78 profit factor. Surprisingly, the filtered version, which should have made the strategy better, actually made it even worse. Looking at the equity curve, we have a similar curve to the previous one with a weaker initial run-up. Again, it is a bad equity curve. To make it profitable, we need some serious changes in the rules of the strategy. But don't forget, we still have one more equity curve, which is for an even more filtered version of this strategy. Let's see. The final version of this strategy only allowed trades on resistance and support breaks. Using the same time interval as before, the strategy took 61 trades, had 19 winners and 42 losses. This brings the strategy to a total of negative 4% net profit with a 0.905 profit factor. While the equity curve does not tell much about it, actually this is the best version of this Larry Williams strategy. This one has a 31% win rate, while the first had 30% and the second only 28%. Well, I won't even mention where this strategy ranks on the strategy ranking sheet. In conclusion, this strategy in its current form is useless. However, I have to mention again that this is not the original Larry Williams strategy. I checked the source from where the rules of this strategy was taken, and there are differences in stop loss placements and the use of a time-based force exit. The key takeaway from this video is to be cautious with every strategy